There's a question that, once you truly understand it, changes how you see the entire financial system of the United States. It's deceptively simple. If the Federal Reserve creates money out of thin air, who exactly does it owe that money to? Most people have never seriously considered this question, and those who have often arrive at a conclusion that seems to make sense at first. Surely the Fed doesn't owe anyone anything if it just created the money, right? But dig deeper into the mechanics of central banking, and you discover something far stranger and more consequential than you might imagine. The answer reveals a financial architecture so counterintuitive that even seasoned market observers sometimes struggle to wrap their minds around its implications. Let me take you back to March 2020, when the COVID-19 pandemic began shuttering businesses across America. Within days, financial markets entered what economists clinically call a dash for cash, a panic so severe that even the safest corners of the financial system began to crack. The Federal Reserve, observing this unfolding catastrophe, made a decision that would reshape its balance sheet in ways unprecedented in modern American history. On March 15th, the Fed announced it would purchase $700 billion in securities, but this was merely the opening salvo. Over the following months, the central bank would create money at a pace that dwarfed even its crisis response during the 2008 financial collapse. By March 2022, the Fed's holdings of securities had exploded from just under $4 trillion to $8.5 trillion, more than a doubling in merely 2 years. Now, when we say the Fed creates money, we need to be precise about what that means, because the popular image of printing presses running overtime is fundamentally misleading. The vast majority of modern money creation is purely electronic. The Fed doesn't call up the Bureau of Engraving and Printing and order pallets of fresh $100 bills. Instead, it executes what's called an open market operation. Here's how it works in practice. The Fed decides it wants to buy, say, $10 billion worth of Treasury bonds. It contacts the primary dealers, a select group of large financial institutions authorized to trade directly with the central bank. A dealer agrees to sell bonds to the Fed, and then comes the crucial moment. The Federal Reserve simply credits the dealer's bank account at the Fed with $10 billion. That's it. The money didn't come from anywhere. It didn't exist one moment, and then it did exist the next moment, created by nothing more than the Fed's authority and a computer entry. This power to create money ex nihilo out of nothing sounds almost supernatural, and in many ways it is the closest thing our modern world has to financial magic. But here's where things get philosophically strange. When the Fed creates that $10 billion and credits it to a bank's account, something peculiar happens on the Fed's own books. That $10 billion appears twice, once as an asset, in the form of the Treasury bonds the Fed now owns, and once as a liability, in the form of the bank deposit the Fed now owes. The Fed has simultaneously made itself richer and more indebted. The money exists, is real, can be spent and lent and used to buy houses and cars and everything else money buys, but it also represents an obligation, a debt, an IOU from the central bank to the banking system. To understand why this matters, we need to step back and look at the Fed's balance sheet as a whole, because this document, published weekly and scrutinized by analysts around the world, tells a remarkable story about the evolution of American monetary policy. Before the 2008 financial crisis, the Fed's total assets stood at less than $900 billion. It had grown slowly and steadily over the decades, roughly in line with the economy's expansion. Then came the subprime mortgage meltdown, the bankruptcy of Lehman Brothers, and the near collapse of the entire financial system. The Fed responded with unprecedented bond purchases, the first round of what came to be called quantitative easing. The balance sheet tripled to about $4 trillion by 2015. Then, after years of gradual reduction, came COVID-19, and the balance sheet nearly doubled again. As of March 2025, after more than 2 years of what's called quantitative tightening, allowing bonds to mature without replacement, the Fed's balance sheet has shrunk to about $6.7 trillion, roughly 22% of America's entire economic output. To put this in historical perspective, before 2008, the Fed's balance sheet was typically around 6% of GDP. We are living in an era of central banking that our grandparents would find almost unrecognizable. But let's return to that fundamental question. Who does the Fed owe all this money to? The answer begins with understanding the liability side of the balance sheet. The single largest category is something called reserve balances. When the Fed buys bonds and credits a bank's account, that bank now has reserves, deposits held at the Federal Reserve. Just as your checking account is your bank's liability to you, these reserve balances are the Fed's liabilities to the banks. As of late 2024, commercial banks held approximately $3.2 trillion in reserves at the Fed. This is money the Fed quite literally owes to the banking system, payable on demand. The second major liability is currency, actual physical dollars. Every bill in your wallet, every $20 note in a cash register, every $100 bill hidden under someone's mattress, all of it adds up to about $1.6 trillion in Federal Reserve, notes outstanding. These notes are liabilities because they represent a promise. Historically, that promise was explicit. You could take your dollars to the Fed and demand gold in exchange. That link was severed in 1971, but the notes remain liabilities nonetheless, backed not by gold, but by what economists call the full faith and credit of the United States government, a phrase that sounds reassuring until you start to unpack what it really means. The third category is the Treasury's checking account. Yes, the United States government banks at the Federal Reserve. When the Treasury collects taxes or borrows money by issuing bonds, those funds flow into what's called the Treasury General Account at the Fed. As of late 2024, this account held roughly $700 billion. When Congress appropriates money and the government cuts checks or makes electronic payments, the funds flow out of this account. Every dollar sitting in the Treasury General Account is a dollar the Fed owes to the U.S. government. There are other smaller categories: reverse repurchase agreements with money market funds, accounts held by foreign central banks, deposits by certain government-sponsored enterprises, but the essential picture is clear. When the Fed creates money, it simultaneously creates a liability. The money goes somewhere, into someone's account, and the Fed is on the hook for it. This is the fundamental answer to our question. The Fed owes the money it creates to whoever holds it, primarily commercial banks in the form of reserves and the general public in the form of currency. Now, for many years, this arrangement was extraordinarily profitable for the federal government. Here's how. The Fed would create money and buy Treasury bonds paying, say, 2 or 3% interest annually. But the Fed paid banks nothing or very little on their reserve balances. The difference between the interest the Fed earned on its bonds and what it paid on reserves was pure profit. And here's a detail that many Americans don't know. By law, the Federal Reserve remits essentially all of its profits to the U.S. Treasury. From 2008 through September 2022, those remittances totaled $1.36 trillion. That's trillion with a T. These were not trivial sums in some years. The Fed was sending the Treasury more than $80 billion, more than $100 billion. This money flowed straight into the government's general revenues, reducing the amount taxpayers needed to contribute or the government needed to borrow. It was, in effect, an extraordinary subsidy made possible by the Fed's unique position. The central bank could create money, use it to buy interest-bearing government debt, and pay little or nothing on the liabilities that creation generated. The profit cycle seemed almost too good to be true. And as with most things that seemed too good to be true, there was a catch waiting in the wings. That catch materialized in 2022. Inflation, dormant for decades, roared back to life. Prices surged at rates Americans hadn't experienced since the early COVID-19. The Fed, facing growing criticism that it had waited too long to act, began raising interest rates at the fastest pace in modern history. In March 2022, the federal funds rate, the Fed's key policy rate, stood at essentially zero. By July 2023, it had rocketed to a range of 5.25 to 5.5%. These rate increases rippled through the entire economy, making mortgages more expensive, credit cards more costly, and business loans harder to obtain. But they also had a profound effect on the Fed's own finances, because of a tool the central bank had developed in the wake of the 2008 crisis: interest on reserve balances. You see, when banks hold reserves at the Fed can choose to pay them interest. Prior to 2008, the Fed paid nothing on reserves, which meant banks had an incentive to lend that money out rather than let it sit idle. But after 2008, as the Fed massively expanded the money supply through quantitative easing, it needed a way to control short-term interest rates, even with trillions of dollars of reserves sloshing around in the banking system. The solution was to pay interest on reserves, essentially, to pay banks for the privilege of leaving money parked at the Fed. This rate, now called the IORB rate interest on reserve balances, became the Fed's primary tool for implementing monetary policy. In a low-rate environment, this worked beautifully. If the Fed wanted short-term rates at, say, 0.5%, it would set the IORB rate at about 0.5%. Banks, seeing they could earn that risk-free rate at the Fed, would be unwilling to lend to other banks or customers for much less. The IORB rate effectively set a floor under short-term interest rates across the entire financial system. Elegant, efficient, effective, but when the Fed needed to raise rates to fight inflation, this elegant system turned into a financial nightmare for the central bank itself. Remember, The Fed's assets, those Treasury bonds and mortgage-backed securities it had purchased over the years, pay fixed interest rates. Many of these securities were purchased when rates were extremely low. Some pay less than 2% annually, some pay less than 1%. But the Fed's liabilities, particularly those $3.2 trillion in reserve balances, now had to be paid at much higher rates. By mid-2024, the IORB rate had reached 5.4%. Even after several rate cuts, as of November 2025, the rate still stands at 3.9%. Do the math. The Fed is earning perhaps 2% on average across its portfolio of bonds, but paying nearly 4% on reserves. When you're dealing with trillions of dollars, those percentage points add up catastrophically fast. Starting in September 2022, the Fed's expenses exceeded its income. The central bank began operating at a loss. In 2023 and 2024 combined, the Fed lost almost $200 billion. In 2024 alone, losses totaled $78 billion. And those losses have continued into 2025. For any normal financial institution, losses of this magnitude would be existential. Shareholders would panic, credit ratings would be slashed, bankruptcy would loom. But the Federal Reserve is not a normal financial institution. It is the one entity in America that literally cannot go bankrupt in the conventional sense, because it can create the very thing it needs to pay its debts, dollars. Yet even the Fed must acknowledge its losses, and this is where we encounter one of the most peculiar accounting conventions in all of finance, the deferred asset. Here's how it works. Under normal circumstances, when the Fed makes a profit, it records a liability called remittance due to Treasury, basically, an IOU to the government representing the profits that will soon be transferred. But when the Fed operates at a loss, what happens? The Treasury doesn't send money to the Fed. That would be politically and practically absurd. Instead, the Fed performs an accounting maneuver. It records a negative liability, which accountants treat as an asset. This deferred asset represents the cumulative losses the Fed has suffered. As of March 2025, this deferred asset had grown to $225 billion. The implication is straightforward. Once the Fed becomes profitable again, which will eventually happen when interest rates fall or when its old low-yielding bonds mature and are replaced by new, higher-yielding ones, it must first pay back this deferred asset to itself before resuming remittances to the Treasury. In other words, the Fed gets to recoup all its losses before the taxpayer sees another dime. Current projections suggest the Treasury won't receive meaningful remittances until 2027 at the earliest, possibly later depending on the path of interest rates. This matters enormously for the federal budget. Those $100 billion annual payments the Fed was making to the Treasury, they're gone, replaced by nothing. The government must either borrow more, raise taxes, or cut spending to compensate. Over the full cycle, from the years of massive remittances to the years of zero remittances to the eventual return of remittances, the arrangement may still benefit the government financially. But the timing and distribution of these benefits and costs create real consequences for fiscal policy and, ultimately, for taxpayers. Now, you might be wondering, if the Fed can create money, why does any of this matter? Why not just create more money to cover the losses? This question cuts to the heart of what central banking really means in a modern economy. The Fed's power to create money is not unlimited in any meaningful sense. Its constraints are not legal or mechanical, but economic. Create too much money, and you risk inflation, the very problem the Fed was trying to combat by raising rates in the first place. The Fed's losses and the deferred asset are a manifestation of a fundamental truth. Even a central bank that can create money faces trade-offs and consequences. Consider the alternative history where the Fed had never engaged in massive quantitative easing. The balance sheet would have remained small, reserves would have been modest, and when rates rose, the Fed wouldn't be paying hundreds of billions in interest expenses. But that alternative history almost certainly includes a deeper, longer recession in 2008 and possibly a second Great Depression. It includes a more severe economic collapse in 2020, higher unemployment, more business failures, more human suffering. The Fed's money creation during crises wasn't free money, but it was arguably necessary money. The bill is now coming due in the form of foregone Treasury remittances, but that doesn't mean the original decision was wrong. What we're witnessing is the unwinding of the most extraordinary monetary experiment in American history. The Fed expanded its balance sheet to nearly $9 trillion at the peak, roughly 100 times larger than it was in the 1970s, when adjusted for the size of the economy. This expansion was not gradual evolution, but revolutionary transformation, driven by back-to-back crises that seemed to demand ever more creative responses from the central bank. We now know what the expansion phase looks like. We're learning what the contraction phase looks like, and we're discovering that the costs and benefits of the entire cycle are distributed in ways far more complex than simple economic models suggested. The Fed is currently engaged in what it calls quantitative tightening, allowing bonds to mature without replacement and thereby shrinking the balance sheet. Since June 2022, the balance sheet has contracted by about $2.1 trillion. But this process must be managed carefully. Shrink too fast, and you risk a replay of September 2019, when a sudden shortage of reserves caused interest rates to spike erratically in the overnight funding markets, forcing the Fed to intervene. Money markets have already shown signs of stress as reserves have declined, with volatility reappearing at month ends and quarter ends. In March 2025, recognizing these pressures, the Fed slowed the pace of quantitative tightening, reducing the monthly runoff of Treasury securities to just $5 billion. The structure of the Fed's liabilities has fundamentally shifted. Before the pandemic, nearly half of the Fed's liabilities were currency on which it pays no interest. Today, nearly two-thirds of its liabilities are interest-bearing. This transformation explains why the Fed is so sensitive to interest rate changes in ways it simply wasn't before 2008. Every quarter-point change in the IORB rate translates to billions of dollars in additional expense or savings. The Fed has effectively transformed itself from a small, nimble central bank, conducting monetary policy through modest interventions in short-term funding markets, into a massive financial intermediary whose own profit and loss statement has become a matter of macroeconomic consequence. There's a deeper philosophical question lurking beneath all these numbers and accounting entries. What does it mean for a central bank to owe money? The Fed's liabilities, those reserve balances, those currency notes, are denominated in dollars. The Fed creates dollars. In a sense, it owes dollars to various parties using a unit that it alone can manufacture. If you owe your friend $20, you must obtain those dollars somehow, through work, through selling something, through borrowing from someone else. But the Fed can simply declare $20 into existence. So is its debt really debt in any meaningful sense? The answer is both yes and no. The Fed cannot default in the way a company or household can default. It will always be able to pay its obligations because it can create the payment medium, but it cannot do so without consequences. If the Fed tried to solve its losses by simply creating more money without corresponding bond purchases or other asset acquisitions, it would be pure monetary expansion, exactly the kind that causes inflation. The Fed's credibility, its ability to conduct effective monetary policy, depends on its restraint. The central bank's true constraint is not its balance sheet, but the need to maintain price stability and the purchasing power of the dollar. This brings us to perhaps the most important insight about the Fed's money creation and its obligations. The system works only because of trust. Banks accept reserve balances as payment because they trust those balances represent real purchasing power. You accept dollar bills because you trust others will accept them from you. Foreign central banks and investors hold trillions in Treasury securities, indirectly financing the Fed's balance sheet expansion because they trust in the stability of the dollar-based financial system. This trust is not irrational or baseless. It's built on centuries of American economic growth, on institutions that, while imperfect, have proven resilient, on a legal and political system that respects property rights and enforces contracts. But trust, once lost, is extraordinarily difficult to rebuild. The inflation of 2021 and 2022 shook that trust. Many Americans began to question whether the Fed had sacrificed its mandate of price stability for other objectives. Some foreign investors began diversifying away from dollar assets. The Fed's aggressive response, those rapid rate increases, was designed in part to restore credibility, to demonstrate that price stability remained the paramount concern. The cost of that restoration shows up in the Fed's own losses, in the zero remittances to Treasury, in the strains on money markets as reserves decline. These are not merely technical details, but the visible manifestations of choices made under conditions of enormous uncertainty and pressure. Looking ahead, the Fed faces questions about the appropriate size of its balance sheet in the long run. Some policymakers argue for returning to the pre-crisis norm of a small balance sheet, perhaps less than 10% of GDP. Others contend that the modern financial system requires permanently higher reserve levels, an ample reserves regime that might mean a balance sheet of perhaps 15 to 20% of GDP indefinitely. The difference between these scenarios amounts to trillions of dollars and has profound implications for how monetary policy operates, how financial markets function, and yes, how much the Fed eventually remits to the Treasury. The story of who the Fed owes money to is ultimately the story of how money itself works in a modern economy. It's a story of IOUs built on IOUs, of liabilities that are simultaneously assets, of institutions that can create what they owe but remain constrained by forces more powerful than law or balance sheets. Forces like trust, credibility, and the collective belief that these pieces of paper and electronic entries represent real value. The Fed owes money to banks, to currency holders, to the government, and in a sense to all of us, because the stability and integrity of the monetary system is a public good that affects every American. When you hold a dollar bill, you're holding a Federal Reserve liability, a debt the central bank owes you. That debt will never be repaid in any conventional sense. You can't march down to the Federal Reserve building and demand they give you something else for your dollar. The dollar is the end of the line, the final form of payment in our system, but the Fed's obligation is nonetheless real. To maintain the dollar's purchasing power, to ensure that the financial system remains stable, to manage its balance sheet in ways that support maximum employment and price stability. These obligations, though abstract, shape the concrete reality of your economic life, whether you can afford a house, whether your savings retain their value, whether the economy generates enough jobs and opportunity. We are living through a historic chapter in the evolution of central banking. Future historians will look back at the quantitative easing programs of the early 21st century, at the trillions created in response to crisis after crisis, at the Fed's transformation from a relatively small institution into a financial giant, whose balance sheet rivals the output of entire nations. They will debate whether these policies were wise or reckless, successful or dangerous. They will have the benefit of hindsight that we lack, but they will surely marvel at this peculiar arrangement. A central bank that creates money by incurring debts to those who receive the money, that operates at losses measured in hundreds of billions yet cannot go bankrupt, that wields enormous power yet remains constrained by forces it cannot directly control. The question of who the Fed owes money to reveals not a simple answer, but a complex web of obligations, expectations, and trust relationships that constitute the invisible architecture of our monetary system. Understanding that architecture is essential for anyone seeking to comprehend the forces shaping our economic present and future.